Hey, on today's edition of the Final Bar, we're going to talk about nice little upswing in stocks on a heavy earnings week. We're going to look particularly at leadership. We're going to do a deep dive on the technology sector. Think about how that leadership portion of the equity space has worked, how it's evolved, what we're thinking going forward. We're also going to do a segment called Clipping Coupons. We're focused on the fixed income market. Think about how bonds should be a part of your overall asset allocation thinking from a technical perspective. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every day after the close to understand the movements in the markets from a technical perspective, connect the short term to the long term, think as long-term investors should, and understand the long-term trends, how they're evolving, how they're inflecting, all the things that we need to know. So a bit of distribution today, obviously, some selling, especially going into the close, a bit of a recovery sort of midday, but afternoon we sort of get Fed news and things are essentially rolling over, finishing at or near the lows for the day, with the S&P finishing down just a touch. So one of the things we're going to talk about today is just thinking about leadership, and so technology and that idea of leadership from tech has been a theme for months now, right? And the strength in Apple and other big tech names has been the key to driving the markets higher. Now that we're correcting a little bit, now that we're digesting geopolitical news and so forth, what does that relate to the long-term trend? What does that mean for tech leadership? So we're going to dig into that just a bit in a deep dive in the technology sector. We're also going to talk about a segment called Clipping Coupons, where we're going to look at the fixed income markets. I've had a lot of people that are very focused on equities, focused on the stocks. You don't think enough about the fixed income side of the space. So let's think as asset allocators, look at bonds versus stocks and how they should be a part of your thinking, be a part of your portfolio, and just what they're doing now as stocks are sort of selling off. Coming up on StockCharts TV and on our show here for the coming weeks, we have a lot of really cool content for you. Today, after this show, we're going to be playing our documentary interview with Ralph Akinpour called 50 Years on Wall Street. We premiered that earlier in the day. We'll be showing it again after the show today and for the rest of the week right after my show. So please make sure you check it out. It's really, really well done. Next week, we're actually going to be on the road. We'll be in Atlanta interviewing some great guests, future guests for the show, and also we'll be at the Money Show in Orlando. If you go to moneyshow.com, you'll get some information about the Orlando show. We'd love for you to join us there for sure. So let's think about the markets. Let's get right to the market recap. So, we have this challenge, or I guess this juxtaposition of a rally out of the open. We came off from the open, but then sort of recovered very nicely, finishing up toward the highs. There's the Dow. This is the S&P 500. We can see following through from yesterday's rally, but then we get news in the afternoon after about 2 p.m. Eastern. We roll over, finish down at the lows for the day. So quite a bit of distribution, some profit taking leading in there. What that's done for the daily chart is sort of this. This is not quite the pattern we talked about before. We talked about a dark cloud cover pattern where you have a nice rally and then a sell-off that goes at least halfway through the previous body. We didn't quite get there, but just visually you can tell that this is more distributive, right? An open, higher end of the day, a close at the lower end of the day. That certainly feels like negativity, profit-taking during the course of the day. So now we're sort of forming what some would call a dead cat bounce, which is a horrible name for a pattern, but it's the truth. So you have a sell-off, especially a quick sell-off, and then you have this quick bounce. And again, the idea with it, sort of the conventional thinking is, this is a quick pause before you continue downward. So really one of two things happens with the chart of the S&P. Either there's more accumulation, the fears about the coronavirus and everything are really unfounded. There's a lot more optimism that comes back in and people start accumulating. We either remain in this general range. So at this point, I think we remain between 31.10 and 33.40. We just sort of back and fill this area, which would be pretty positive. I don't see us going dramatic new highs, but we hold up okay. That would be kind of nice. Option two, we break below this swing low from earlier in the week. We break below the previous low, 32.10, break down through the 50-day. That would sort of complete this dead cat bounce, resolving downwards, feeling that this is deeper and more severe than a lot of people are expecting or are prepared for. So I think one of those two things happened. So again, for now, I think the line in the sand is 32.30, which would be the low from Monday's session. That was the gap down after the weekend news and a lot of concerns about the news from China. So, do we hold that level? Do we hold that level of support? And if we break it again, I think the really key levels are 32.10, which lines up with the low from December, and the 50-day. That would also most likely coincide with an RSI around 40. And if we're able to break those levels, it tells you this is a deeper correction than some might be wanting to hear about. I would caution to remind you that the market can correct in two ways. It can correct in price, which would be a downward move in price. It could correct in time, which is more a time to digest the previous gains, or some combination of the two, a price and time correction. A lot of people think if the market's not dropping dramatically, it's not really correction. A lot of times it's more just a time correction. Maybe back here in August, you could consider that more of a time correction. We didn't lose a ton of value, but we just spent quite a while before we sort of reclaimed the previous highs and sort of resumed that uptrend. And it could be something like that. And based on how nice and steady uptrend that we've had, that'd actually feel pretty challenging if we do that. Let's get to the rest of the markets, think about what's happening. I like to look at large versus mid versus small, and it's sort of following a traditional bearish configuration. Small caps down the most, almost 0.8%. Mid caps down a little less, almost 0.5%. And then the S&P finishing just in the red going into the close. And again, most of that happened in the last 2 hours of trading, really after the afternoon news came out. From a sector perspective, industrials ended up positive for the day and still holding up fine. Materials, number 2. Technology, third. So interesting that tech remains positive on a day when you ended up having a lot of profit taking. Obviously, you've had good news from Apple. Apple's one of the number 1 rated stocks from our proprietary scooter rankings, which is a huge market cap weight in the broad market, but especially in technology. So that's certainly helped to buoy up the sector here. On the downside, we have energy, and again, don't take anything I say as a recommendation, but boy, if you own the XLE here, I'm a little concerned that you're not looking at enough charts because, when things go down and to the right, that is usually not a technical reason to want to own it. You want to look for some sort of accumulation. We really have not seen that with energy, and even on up days and down days, energy manages to remain toward the bottom of the list, which is not an encouraging sign. Real estate down at the bottom as well. It's a little interesting, not as much of a defensive play with real estate bubbling to the top. But again, when a lot of things rotate toward the end, I think some of the sector themes don't necessarily play out as clearly as they might have otherwise. Looking down here at ETFs, actually China recovered okay today. And again, a lot of this is based on expectations and then news flow and what's happening. If things, if things seem less of a challenge, if the system is better prepared to handle people getting sick and it won't be as much of a global issue as initially speculated. You'll see China ETFs bubble up very, very nicely. On negative news days, you'll see it drop pretty quickly. Today was a nice recovery day for a lot of the Chinese ETFs, which have been down so much. We talk about the FXI pretty often. The MCHI is another common one. So again, coming off a pretty depressed level after about 2 weeks of selling off pretty good, but the last 2 days kind of jumping up pretty nicely there. In terms of the industries, we're going to dig in a little bit of technology here later. So I want to point out that computer hardware up 1.7%, again on a day that ended up sort of flat to down. Also noticeably at the top are some industrials groups, diversified industrials, but also railroads. Railroads have been one of those groups that sort of bubbled up to the top here for a little while. And on a relative basis, interesting, right? Starting to improve on a relative basis. So holding up very nicely, testing new highs. New price highs today is not a new closing high, but overall the relative strength really improving. So as the rest of the market kind of stagnating, pulling back a little bit, you have railroads, diversified industrials rallying very nicely. Hotels as well, which is kind of an interesting one coming off quite a low point. On the downside, you have some of the communication services, fixed line telecom, mobile telecom. So this includes things like AT&T, Verizon, CenturyLink, those types of stocks. That's actually the worst group of the day. Big down move. And again, with an earnings week, you'll have a lot of significant movements. I think it was worth noting here, and this is why I wanted to do the deep dive in tech. Semiconductors actually one of the worst groups today. So you had tech toward the top of the list, computer hardware. You had tech toward the bottom in the form of semiconductors. So we're going to dig into that a little deeper later in the show and talk about some further themes there. I do want to get on to our next segment, however, which is called Clipping Coupons. So the idea with this segment, we were talking about some of the new things that we could do and new ways to introduce some of the benefits of charting and ways to frame out what we're seeing visually. And one of the things we talked about was focusing a little more on different asset classes outside of the equity space. So we did look at commodities last week in one of our shows. Today we're going to look at, in this segment, Clipping Coupons, looking at fixed income. And for those of you that are younger viewers that have no idea why we would call something about bonds clipping coupons, the elder statesman on the viewing today will probably be able to tell you that when you used to own bonds and you actually had a certificate and you would clip off these little coupons, you'd send them in and you'd get your coupon payment. You'd get your biannual, semi-annual, or annual payment. That was sort of your interest for loaning the company money, and you literally would clip the coupons and send them in. So even though none of that is done anymore, you still talk about coupon payments for bonds, which are basically that interest rate. You loan the company or the government money, they pay you an interest rate in the form of a coupon payment, and then at the end you get your principal amount back. So that's why, for those of you that don't know, that's why it's actually called clipping coupons. So how do we think about fixed income relative to other asset classes? What are the charts telling us right now? What are some things we want to keep in mind? Well, I always like to start from a broader asset allocation process and think about how bonds relate to other assets. There are two ways that I like to do that. One is by looking at a broad chart of returns over a long period of time. So here we're looking back to the market low at the end of 2018, and we're looking to where they are just as of the close today. And we can see over that period, a little over a year and a month, we have the S&P 500 up 42%. One that was up, this was oil, that was actually fairly competitive, but has now come back down. It's up about 20% over that same period. Had been up about over 40% for that period, but gave about half of those returns up just in the last month. Next, we have gold, which has actually been up 24%. So a lot of people don't realize how well gold is actually appreciated because we've been focusing so much on stocks. If you had part of your portfolio allocated to gold, that's not too bad. You wouldn't be too upset by that. And then right after that is the TLT, which is a long bond ETF, up 22%. The weakest part of the picture has been the dollar, the U.S. dollar, up just under 6% for that same time period. What's interesting about these charts is if you dial them down a little bit, so if we change the starting point and instead go back to, and I'm just going to quickly do this, not worry too much about it. Let's go back to like the beginning of October of last year. So this is back, the market sort of bounced off. First week in October, we had a low in the S&P. We can see we've rallied since then. I think it's interesting to note that the S&P's up almost 11% for the last 3 months and change or so. Second is gold, up 7%. We then have the TLT bonds up 1.7%. So had been a negative performer, but now starting to improve. So what's interesting is as stocks have started to pull back a little bit, you see fixed income has actually improved very nicely. So bond prices have done much better. So the question now is, what happens, right? If we continue to see weakness in stocks, does that mean we should be focusing more on a bond allocation? How should we sort of think about that? So the second way that I like to do it is by looking at ratios, and I'm going to quickly try and find this stock to bond ratio. This is deep in my list of ratio charts, should be on page 2. Here we go. So this is stocks versus bonds, just a simple ratio of the SPY versus the TLT. In general, when this ratio is going higher, that means you're favoring stocks over bonds. And again, it's just based on the performance over that period, just a ratio which is outperforming the other. If this line is going down, that means stocks are underperforming bonds, or bonds are outperforming stocks based purely on price returns. So I've not updated this in a couple weeks, but you can see I probably could put a red arrow indicating a bit of a rotation back over to the bond side. We'd had it favoring stocks for the last 3 months. That trend sort of continued. But then I was sort of waiting to see a breakdown in the ratio. We've actually have seen that. So we've seen this ratio turn lower. So again, what you always want to see, are we breaking below the previous low, which we actually have from the first week in January? I think this is starting to favor more bonds over stocks. So how do we think of that in terms of a technical perspective? So here's my look. This is the way I like to look at intermarket analysis. I'm looking at commodities, and then this is the line when I start to look at fixed income instruments. So I have the 10-year Treasury yield, $TNX. I then have the TLT and the IEI. So these are bond ETFs looking at Treasury bonds. So the TLT is one of the more liquid Treasury bond ETFs. So it's just looking at U.S. Treasuries. Then we have the AG, which is actually a combination of Treasuries and corporate bonds, then we have the LQD, which is, as far as I can remember, all corporate bonds, right? So this is from the government, this is from companies, and then you have the ag, which is probably about 40%. Treasuries would be my guess. It's probably around there, 30 to 50-ish percent, probably 40% or so. I'm looking at treasuries versus corporate bonds. That is why that weighting that I just showed you is why the TLT looks like this. This is the last 2 years. You can see the run up in 2019, what I call the descending triangle pattern, a consistent support level, a lower highs over that period, resolved to the upside, broke above the most previous highs, really rotating into a position of strength. But if we go a couple charts over to the Ag ETF, this now incorporates some treasuries, but it's over half corporate bonds. We can see this is actually much more attractive, right? It's actually closing to new highs today, had a much, what we call an ascending triangle, a consistent resistance level, increasing support levels, right? Higher lows, a breakout to the upside. That was a really nice, clear, almost a cup and handle like sort of rounding bottom pattern, basing pattern before we break out. But then you look at the LQD, which is all corporate bonds, you can see this is even more positive. So the real strength in fixed income over time has been driven primarily from corporate bonds over the last 6 months or so, even though overall all of them look fairly constructive. So what's interesting now, when you look at something like the Ag ETF, AGG, and there are others, there's the BND, which is another very, lot of assets, very liquid. So there are other ones. I'm just showing the ones that I tend to gravitate towards. I love the fact that there was a nice run up. I had this trend line that I'd drawn following the lows. It tracked that trend beautifully, then sort of broke that in the fourth quarter of last year. Consistent resistance level, increasing support level. We resolved that higher after some nice bounces off the 50-day moving average, now in a position of strength. What concerns me, or what is interesting to me now, is that we're overbought. And I think the ag is a really good example of what happens when we're extremely overbought. Coming out of the market low in December of 2018 in equities, you had the ag rally. It became extremely overbought on RSI above 80. We can see that meant a lot of upside momentum. And that's sort of what we've been seeing through that period, right? Through much of 2019. Potentially, we're starting to repeat this breakout with an extreme overbought condition. And I want to leave you with this chart. The one I'm looking at is the ag, to see if we become extremely overbought. I think that would suggest a lot of upside momentum, a lot of people rotating into more of a bond allocation, which would mean any sort of pullback you'd tend to think is pretty buyable, expecting to ride it to the next highs. So that was our segment, Clipping Coupons, thinking a little bit about bond ETFs, how to think about it in relation to equities. And again, at a time when equities are in correction mode and sort of, anxiety mode, where else can we look? And I think in the bond ETFs, you're seeing a lot of strength you're not seeing in some of the equity charts we're looking at. We're going to take a quick commercial break. We're going to be back with a deep dive into the technology sector. We'll see you in a minute. Hey everyone, welcome back to the show. Thanks for keeping your questions and your feedback coming to us. You can email us at thefinalbar@stockcharts.com. Many of you have sent in some really thoughtful questions and feedback. We love hearing from you. Please take your time to do it. It can be anything, looking at charts, thinking about stockcharts.com, just the overall market environment, whatever we can do to help you understand the markets from a technical perspective. We'd love to do it. So shoot us an email anytime you can. Our next segment is a sector deep dive. What we love to do is dig into a sector in a little more detail. A lot of times with the show, we have to keep it sort of surface level just due to time. But I love to take some time and deep dive into a particular sector and think about what's happening, what are the different charts doing, how you should think about it relative to other sectors out there. When we're thinking about the equity space, we have to think about the strength in technology. So here we're looking at the RRG. This is the relative rotation graph. Julius de Kempener does such a good job explaining how to do it in his show, Sector Spotlight. So check that out if you haven't already. But I'm showing you the weekly RRG. This is part of my weekly process to understand sector rotation. The XLK being up and to the right, heading northeast, shows you the relative strength of tech versus the rest of the markets. While a lot of sectors have struggled, healthcare had been in a great position of strength, rotated lower. Industrials have been strong, rotated lower. Financials, consumer discretionary, all of those other sort of traditional offensive sides of the markets have all sort of rotated lower. Tech has actually remained sort of long and strong. I'm going to move the chart back a little bit, rewind back here to the October market low, and then we're going to reset it up. You can see tech down here was in the weakening quadrant, but look at how it just rotates northeast and now heads back to where we're at now. So one of the more effective ways to use this, I found, is when something has been strong, it rotates more on the weakening side and then turns around and comes back northeast, heads back into the leading quadrant. That's essentially what we've seen from tech. Now, the XLK is driven a lot by the strength in the biggest names, things like Apple. So when Apple's doing well, the XLK tends to look pretty good, and certainly the broader market as well. So this is the chart of technology in the form of the XLK for the last 2 years. We can see this beautiful uptrend, right? From the market low, December of 2018, we've just had this great pattern of higher highs, higher lows, a bit of a hiccup here last August after the market pulled back a little bit, but then we resumed back to the upside. And again, since then, it's been sort of textbook uptrend, long and strong to the right. The relative performance has been consistently strong as well. So if you start the clock just about the beginning of the year, first week in 2019, in January, we're up about 22% over that period. So it's just been a strong relative performance. That's on a relative basis to the SPY. So overall, it's been very consistent. This sell-off that we've had, this little pullback in stocks, is just the rounding area you see on the far right corner here. So overall, the trend remains pretty positive. So with something like the XOK, you're always looking at where we're at relative to the most recent pullback. So 94.50 to 95 is sort of this level right here, which was the low that we saw from Monday's sort of gap down with a lot of stocks. You'd want to see it hold that level, remain above there, ideally make new highs. That would sort of continue this uptrend pattern. The relative strength remains very positive. So while other things have sort of struggled, the XOK has been okay. So how do we go the next level down and understand what's driving the movements in technology? The industry summary page is a really good way to do that. If you're not familiar with it, go to Charts and Tools and you'll see a link for the sector summary and the industry summary. I love to look at this page because it shows you the industries that make up a sector, and you can sort of see that next level down. You can see what's happening. What I do is I sort it by scooter ranking. So this is based on our technical ranking. The higher the number, the stronger the trend, and it's a percentile ranking. So compared to all the other industries out there, computer hardware within technology is literally the #1 industry group. If you click on the chart, sorry, that's not the chart. Come on, Keller, here we go. Click on the chart, the little chart icon. We can see that even though the market's pulled back a little bit, computer hardware actually making a new closing high today. So even though the rest of tech has suffered a little bit today, the overall market pulled back to the lows. Even though we had a little bit of a sell-off, the computer hardware group actually remained at new closing highs. And look at the relative strength. So in the last year, up 53% relative to the S&P 500. So it's been an incredible relative performance. Again, Apple's in this group, some names that you're certainly familiar with. The way you see what's actually in the group is what I did before. Click on the title of the group. It's going to show you this page. A couple ways to do it. I like to group them by market cap and go down to the large cap names. These are the ones you're going to be most familiar with, things like Western Dig, HP, Apple, Seagate. These are names you're probably very familiar with. And if you click on the chart, you'll see that the chart of Apple looks very similar to the chart of computer hardware. And again, because it's such a big weight in that group, right? A lot of the returns, if not all of them, are going to be driven by the move in Apple. So as long as Apple remains in a position of strength, that group is actually going to do very, very well on a relative basis to the rest of things. But what is the rest of the story here? Couple groups I want to hit on. The next one is semiconductors. We've talked about semiconductors often because I find they're a real good bellwether group for overall market strength. So when this group is doing well, the overall market tends to be doing pretty well also. So I've grouped this by the large cap names. You can see there's quite a few large cap names in this group. Something like Applied Materials might be a good example to just look at. What's happened with some of the stocks in semiconductors, and you saw they were at one of the worst performers today. We can see that they had sort of this bearish engulfing pattern. This is from Applied Materials pullback, and now it's sort of at that line in the sand at the 50-day moving average, also testing the low from the first week of the year. So I think, again, this is a really key point for this type of chart, right? Does the 50-day hold? Does the previous low hold? Does the RSI hold at 40? If those things happen, this is a great buyable dip like we've seen a number of times during the last 6 months. If, however, we start to break down meaningfully through that support level, break down through the 50-day, the RSI goes down below 40, the relative strength suffers, I think you have to be a little more concerned about the broader market. So I love to ask interviewees, what is your one chart? My one chart might be something like Applied Materials, which would just be a great chart to sort of show a stock in a group that had done very well, a relative strength improving here tells me good things about the overall market environment. Some pullbacks, some breakdowns would be concerning, and I think that's one of the groups, that's one of the stocks in one of the groups to pay special attention to. Just to wrap up the segment, the last thing I would remind you is take a look at some of these other groups, especially ones at the lower end. So things like computer services, telecom equipment. These are names and groups you may not be as familiar with, but what's interesting is even within technology, which overall has been very strong, you actually have some groups that are relatively weak. This is one of the worst groups out of all of the industries around the U.S. equity space. So dig a little deeper into those when you have some time and see what sort of themes, what sort of stocks you can dig out there. So that is our deep dive into the technology space. And again, if there's one chart to keep an eye on, I think Applied Materials is a really interesting one. We, however, need to wrap up our show by going to the 3 in 3. So at the end of every show, 3 charts in 3 minutes. If they're not on your radar yet, they should be at this point. The first one is the AG, the long bond ETF. In our segment, Clipping Coupons, we talked a lot about these fixed income ETFs, how AG relates to the TLT, LQD, other tickers you may be familiar with. And again, it's all about government bonds versus corporate bonds versus a blend of the two, and that's what we're seeing here on the AG. I think one of the really important charts or signals to pay attention to is the RSI here. It's clearly setting up very nicely on an absolute basis, has done very well, starting to outperform the S&P 500 because we're at new closing highs while stocks are pulling back a little bit. I think it'll be very interesting to see if we become extremely overbought here, which is what sort of started last year to be such a fantastic time for the bond indexes, because you had an extreme overbought condition, which told you there was so much momentum coming out of this breakout. My question now is, do you have a similar sort of configuration here? If not, it tells you we have a little bit of more of a pullback to maybe stop and digest. The second chart is the GLD. We didn't talk a lot about commodities today because we talked about earlier the week in a little more detail, but I've compared what we're seeing now on the GLD to what we saw earlier in the year, right? The first half of 2019, where we had this corrective period, a break to new highs, and then we became overbought, and that's sort of the same thing that we saw here going into the end of last year, and the break above 143 on the GLD got it above the resistance from October. I thought that was very constructive. Now testing new highs, once again trying to break out. What's very interesting here is this pattern just seems to keep lining up here. So now we have higher highs in price, a bearish divergence in RSI that's very similar to what we saw in June and July of last year. A bearish divergence, higher highs in price, bearish divergence here. What negates that bearish divergence is when you break to another new high. And so that's the question I'll be looking for here. Do we get meaningfully above 149, 150, which would sort of complete the pattern we saw here, suggest further highs in gold. And overall, I think it's setting up very constructively. And then the last chart for the 3 in 3 is the dollar. We had sort of a bearish case for the dollar going into year end, breaking down through new lows, changing this pattern of viable corrections in the dollar. The RSI remaining below 60. That has actually changed. The price has gone back above moving averages. The RSI back above more in the bullish configuration, above 60, really suggesting less weakness in the dollar, more strength relative to other places. Ladies and gentlemen, that is our show for today. I want to appreciate so much you joining us today and every day on the Final Bar. Every day, 4 o'clock Eastern, 1 o'clock Pacific. We love to take a look at the charts, relate them to the long-term trends. Hopefully, we've been able to do that for you here. Please keep your questions and your feedback coming. The Final Bar at StockCharts.com is a great place to get a hold of us. You can also look for us on Twitter at FinalBarSCTV. And you can also hit us on the Q&A during the show. We look at that every day, make sure we capture all of your questions, all of your feedback. So thanks so much for making the show as interactive as possible. Did want to remind you immediately after the show today, 4:30 Eastern, we're going to replay our documentary interview with Ralph Acampora called 50 Years on Wall Street. Gretchen, our producer here, whose birthday it is today, by the way, did a fantastic job creating a beautiful story about Ralph Acampora, his fantastic 50-plus years teaching the street how to use charts, how to use technical analysis. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night.